For years, property and casualty insurers have been really focused on differentiating themselves with strong underwriting. Today, investment strategy is becoming just as important. The industry has benefited from years of exceptional underwriting results. As pricing moderates and underwriting margins normalize, investment performance is only going to matter more. It's no longer just about generating yield, it's about building a portfolio that supports profitability and long-term resilience. That's why we're seeing investment strategy move from a supporting role to a true competitive differentiator for property and casualty insurers. The biggest investment tailwind of the last few years wasn't security selection, it was the higher interest rate environment. Rising interest rates have allowed most carriers to reinvest their portfolios at much higher book yields than in prior years. Most portfolios were able to participate in that and capture benefit, resulting in higher investment income levels for their companies. Going forward, we expect that higher returns for companies are going to come more from portfolio construction, sector choices, and security selection, not simply waiting for bonds to mature to be invested in this higher interest rate environment. The next chapter is going to be much more about investment decisions, not interest rate tailwinds. Over the past several years, many insurers have increased their allocations to cash and short-term assets. Today, it's worth asking whether those assets are still working as hard as they could. Now, cash and short-term assets are an important part of the portfolio and can help protect in periods of uncertainty or market volatility. However, they could also represent excess liquidity on your balance sheet, which could lead to an opportunity cost of foregoing higher interest rates by investing elsewhere. Every insurer is different, and their investment strategies should be tailored accordingly. Many are thinking about how much liquidity they truly need and if their capital could be redeployed elsewhere to capture more competitive yields. The question isn't whether you need some cash or short-term assets, it's how much you need and where else you should be redeploying that excess cash. Diversification today means much more than simply owning stocks and bonds if you're an insurance company. Insurers continue to expand their portfolios, incorporating more structured credit, private assets, specialized parts of the fixed income markets to help pursue different return streams for their portfolios. Their objective isn't to create a more complex portfolio, it's to capture multiple sources of return while managing and balancing the liquidity, capital, and risk considerations that they're pursuing. The most resilient portfolios today are built around thoughtful diversification, not simply pursuing the highest yielding asset. One question every insurance investment professional should be asking today is our portfolio positioned for the market that we're heading into and not the one that we've just come out of? Underwriting conditions continue to evolve. Investment income remains paramount for insurers' portfolios. Capital efficiency continues to come into focus as insurers consider new investments, and the investment markets continue to evolve around them. Insurers need to continue to regularly challenge their assumptions about what their portfolio should be today in order to be better positioned for tomorrow.